The following program sponsored by Adams Financial Concepts.
About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it's Thursday afternoon, so we're talking about money, unless you're listening to me on Friday, in which case we're still talking about money, or Saturday evening. Same programs broadcast Thursday, Friday, and Saturday, so you could be listening at one of those times. We're still saying the same thing each one of those times. So here we go. We got a lot to cover today. The president made a big announcement today. I'm going to talk a little bit about that in relation to some of the other things that are going on in the world. Want to stick around for that? It's about climate change. Big potential impact on what is happening there. And we haven't got time to do a full program. That may come next week or the week after. We'll be talking about climate change and the impact of what he had to say today. Also, at Rotary this week, the artistic director of the Intiman Theater mentioned work they were doing for a well-known financial person at Intiman Theater. I've got more to say about that as we go along, and the person who they're working for. I flew all the way across the country to Florida once to hear this person and understand what he's doing. I have a very different approach than he does, and I'll tell you about the differences. That's coming later in the program. I've got a guest today that says he can put a price on every house in the country, and has done that, and has a unique approach to what's going on. So you want to hear what he has to say. But I want to begin with talking about benchmarks and mutual funds and money managers. When I got into the business back in the mid-'80s, most people benchmarked their performance against the Standard & Poor's 500 or against the Dow. Those were the benchmarks that were used. Some used the Russell 2000. Some used the Russell 5000. Some used the small cap index or the large cap or the medium cap. But if you look today at Morningstar's list of indices, you can log on and look at Morningstar. You can look at the indexes. It's a long list. So what's going on? You know, it started out with people coming up with reasons for underperformance. I can remember in the mid-'80s, the big thing, and it continues today, was to talk about a risk-adjusted rate of performance. Risk-adjusted. What does that really mean? That means if you're doing better than the market, you must be taking more risk. Doesn't it? So by adjusting the risk, you come up with an equivalent to what an equivalent risk was. But it's an interesting thing, because I looked at two stocks back when this first came out. I looked at the two stocks, compared them to the Standard & Poor's 500, found that one had a much higher risk-adjusted rate of return than the other did. The safe stock is not one I would have invested in. The risk stock at that time, and this is 1987 when I was doing this, the risk stock I was looking at, the risk-adjusted stock that had the higher risk, was Microsoft. The safer stock, according to a risk-adjusted rate of return, when you compared it to the Standard & Poor's 500, which stayed closer to the Standard & Poor's 500, was Pan Am. Now, Pan Am went bankrupt. Pan Am went from that point to zero, but it was much closer to the Standard & Poor's 500 line than Microsoft, because Microsoft soared. So in terms of risk-adjusted rates of return, you'd say that investing in Pan Am was a much safer bet than investing in Microsoft. Not really. Not really. I mean, these are things that have come up to explain underperformance. You know, you look at value stocks, you look at growth stocks, large, small caps, international stocks. They begin to put in more and more indices. And what happens when money managers underperform? They look to create a new index. You know, if you create a new index which shows you're doing better than that index, you look great. You know, and there are times when in managing money, I underperform. There's no question about it. That happens. That happened in 2016. I underperformed the market. That's typical of what happens with money managers. People have done studies and found the people that are the closest and have the least underperformance also have the least overperformance. They tend to reflect an index rather than actually reflecting stock selection. A slight underperformance is probably not a great performance. Eugene Fama shared the Nobel Prize in 2013 with two other Nobel Prize winners in economics, and his studies showed that fewer than 7% of money managers outperform, actually not even outperform, earn their fees is the way he put it. Fewer than 7% earn their fees when you look at performance over the long term. So if you look at performance over a 10-year time period, fewer than 7% of money managers will have a performance that's as good as the Standard & Poor's 500 when you measure them against their actual performance adjust with the fees that they're charging. You know, we've been able to do better than that sometimes. Most of the time, if you look at our long-term performance, it's there. That's very few people, very few money managers are able to do that. That's what Fama found. That's what Charles Elliott found when he wrote the book, Winning the Loser's Game. And in that book, he said professional money managers, fewer than 10% outperform the market. So the way to win is to lower your expectations. I don't believe that, but that's what he believed. That work was verified by Burton McHale, who also found that fewer than 10% money managers outperform the market over the long term. There's very few that actually do. You know, Gary Palmer wrote, "The harder I practice, the luckier I get." I don't believe that's true in mutual funds with fewer and fewer managers. There's a study that was done by Gary Porter and Jack Triffs, published in the Financial Analyst Journal a couple years ago, 4 years ago, 3 years ago actually. They looked at the role of merit, the career paths of mutual fund managers. And they looked at mutual fund managers who were managing at least one fund, and they were solely managed. Some funds have committees who manage, some have pairs of managers or multiple managers. But 2,846 funds in 1996 had a single manager. 1996. Remember, we're coming into the time of the dot-coms. We're coming into the time of the crash of 2000, the dot-com crash. By 2008, 1,825 managers were gone. Actually, there were 1,825 managers that began. Most of them were gone. Only 195 managers lasted 10 years. 19% were gone within 1 year. Another 19% were gone in the second year. So almost 40% of the money managers were gone within 2 years. Another 17% disappeared in the third year, and another 12% in the fourth year. 2/3 of the money managers were gone in 4 years. 2/3 replaced by other managers. Sometimes the funds were merged out of business. Sometimes they were just liquidated. Sometimes they brought in another money manager, and usually the second money manager seemed to have early outperformance until they too dropped off and disappeared. When a fund underperforms, it could be just the fact of the type of stocks that they're invested in, the type of market they're invested in. And as the market rotates and shifts around, you bring in a new manager. He happens to hit it at the right spot. He has great performance. But managers of mutual funds are measured on their performance, and they know if they beat the market or not. It's very easy to see whether they're winning or losing. And we live in a time right now with the market doing what it is, where that becomes critical. There's an old saying that the market is driven by fear and by greed. And I think there's a third factor for most money managers. It's a fear of looking stupid. It's a fear of being out when the market's going up. It's a fear of being in when the market's going down. And so you're looking constantly over your shoulder rather than looking at where your fund is. We're going to come to a commercial break, so don't go away. We've got a lot more to cover, not just in mutual funds, but I've got a great guest and I've got great stories. Don't go away. We'll be right back.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
6-4.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
And I've been talking about mutual funds and managers of mutual funds and the rapid turnover of the managers. There was another study that was done by the founder of Fund X, Janet Brown, and she talked about, or the study was done on funds that had lasted for 25 years. You'd think there'd be a lot. They looked at 10,454 mutual funds and ETFs. 10,454. Wouldn't you expect that a significant number would have lasted? Wouldn't you expect it to be several thousand? No. There have been 269. That's all. Less than 300 funds that have lasted 25 years. And they looked at those funds to see what it was about those funds. There's a lot of publicity, a lot of published studies showing that the higher the fees, the worse the performance of funds. When you looked at the funds that lasted 25 years, there was no relationship between the fees and the performance at all. Some of the best performers had low funds. Some of the best performers had high funds or high fees. There was no relationship at all between fees and performance. There wasn't a relationship between the longevity of the managers either. But those funds were the ones that have lasted for 25 years. And if you look at it, Janus just announced that their Janus fund, their original fund, that one that was around for a long time, that's going to be folded into and merged into Janus Research. Janus International equity is being liquidated. Those are the types of things that happen with mutual funds. I had a client once who had a mutual fund, and I was brand new in the business. I'd been in the business for only maybe 6 months. And when I was working in the wirehouses, the big brokerage houses, mutual fund wholesalers used to come into the office and tout what was hot at the time. And I can remember what happens in those brokerage firms when somebody leaves the firm. They distribute the accounts to the other brokers with the idea that the other brokers tell how terrible this broker is that left, whether he was good or bad or indifferent, it doesn't matter. And you try to keep those clients not moving with the financial advisor, but you try to keep those clients in-house. And I had one client that had invested $10,000 in a mutual fund, and that mutual fund was worth $8,000. And I go into this wholesaler meeting, and he's touting this particular fund, and that had a return over the last couple of years of 20% per year. And I'm going back and I think I wasn't for sure that was the fund that my new client had. I went and I looked, and sure enough, it was that fund. My client hadn't received a 20% per year return. They'd lost 20% in that period of time. So I came back and I asked the question. I said, this is my client. This is when they invested. They're down 20%. They're not up 20% the last couple of years. And that's when he said, there was a smaller fund that had a much better track record. And they merged the big fund into the small fund and used the small fund's track record. That's how that was marketed. Many times they launch a fund and 1 or 2 years later realize it hasn't got a track record, so they liquidate it out completely. That just doesn't seem right to me. But that's what goes on. If you look at the best performing funds, R.W. Baird did a study of over 4,000 funds, and they found that 370 of those funds had actually outperformed their benchmark over a 10-year time period by an average of 1% per year. So that if you looked at the funds, if you looked at where the funds began, 100,000 began, and where they ended at 400,000 or 500,000 or whatever it was, that if the Standard & Poor's had gone from, in an index fund, gone from 100,000 to 400,000, these actually had gone from 100,000 to 500,000 or whatever it might be. So I don't know those exact numbers. But they looked at what happened during those 10 years. What happened? Did the fund perform consistently every year? What they found is that 100% of the funds underperformed for a significantly long period of time, at least 1 year and often more. 85% underperformed for 3 consecutive years or more. 57% had been down at least 10% and 25% down 15% or more. 25% underperformed by over 5% for a period of over 3 years. Think about that. So if you're sitting and looking at your fund performance and it's underperformed for a couple of years, you begin to think that they've lost their touch. You move on to something else. And so you end up with something where you switch out and switch into the wrong thing. There's that going on. It's difficult to know. You have to look at a long-term track record and make a decision. You know, we have the same problem. I underperformed last year. If you look at the numbers coming out for the second quarter, I think you'll see that this year is going to be very good. We're not done with the second quarter, but right now I'm very guardedly optimistic it's going to be a very good time and we're catching up. That happens. There's one particular case I want to talk about in terms of funds, and that's bond funds. There's a lot of talk about bond funds. When you have a bond itself, it has an issuer that has a credit quality, that has an underlying rating, whatever it might be. You have a coupon and you have a maturity date. You know that at a certain date you're going to get your money back or have a high probability of getting your money back, and you know what interest you're going to receive. With a bond fund, you don't have a maturity date. You don't have a rate of interest that's consistent or set, and they can reduce that dividend at any time. If you look at bonds, there's been work that's been done that shows the return on bonds is threefold, and about 1/3 of the return on bonds comes from each one. One is the coupon interest, what the bond is paying. If it's a 3% bond, that's 3% that you're receiving. If it's a 5% bond, you're getting 5%. The second is capital appreciation, because if you buy a discounted bond, you'll see capital appreciation. There's kicker bonds. There's all sorts of different types of bonds where 1/3 of the return can be from capital appreciation, and 1/3 of the return is reinvestment of the income. So if you're a person that buys a bond and holds a bond, what you're really getting is only 1/3 of the potential out of a bond. And when you're buying a bond fund, very often you're not even getting that full amount. And when you do a ladder, there's a lot of talk today about doing ladders, because if interest rates go up, you want to be rolling over bonds at higher and higher interest rates. If you're doing a ladder, you're giving up capital appreciation, you're getting the reinvestment rate, and you're getting the coupon rate, but you're losing the capital appreciation. There's a way to do bonds. And in my opinion, doing a bond is the right way to do it. You get the capital appreciation as well. Anyway, that wraps up that part of the program. I want to introduce my guest, Brian Copley of City Builder. Welcome to the program, Brian.
It's a pleasure to be with you here, Mike. Thanks for having me.
So why don't we start with your background?
Sounds good. I'm born in Seattle, went to University of Washington, told my dad that the only thing that I figured I was good at by the time I got into college was dropping out, so dropped out 3 times. Actually ended up working with my best friend's dad right out of college doing real estate investing. And he told me to come over after work and he'd show me a few things. And so we walked outside. He pointed to the street and said, "Show me all the homes for sale." And so I pointed to 3 yard signs. This is in 2004 in Phoenix. And he said, "No, you're wrong. Every house on this street is for sale for the right price." And I've been working in real estate since 2004. I've run 5 companies, started 3 in the real estate space, worked for Wells Fargo Advisors, got a Series 7 and 66, licenses to sell stocks and bonds. So very interesting early portion of the segment today. And since 2016, I've been CEO of City Builder. And City Builder has a provocative message for your audience today, and that is that there are actually 2 correct valuations for their property, not one. So you go talk to a real estate agent, or you go to Zillow or Redfin, and you see a value. But I would challenge that there are actually 2 accurate valuations for every property in the world. And the first would be what it's worth as what it exists as today. The second would be the best and highest use value, or what can we actually do with this piece of land, and what is that opportunity worth to a builder or to a developer.
So let's talk about the first one, and then we'll get to the second one. There's a big thing going on with Zillow today, or in the past few weeks. Zillow has put out a $1 million prize to any group that can come up with an algorithm that comes up with a more accurate estimate of homes. Because while Zillow combines all the economics to come up with a picture of home values, they find that values are oftentimes wrong by 7 to 10 to 15%. I can say in my home, we sit on the water, or just across from the water. We have a great view back into downtown Seattle. Somebody did a drive-by when we were talking about refinancing to lower our interest rate, and they did a drive-by and found they should deduct $70,000 from our home value because a home on the hill, which had a worse view, they rated as a better view computer-wise. So you have this thing going on with Zillow to come up with a way to better measure real home values. So give us some insight into what's going on there.
Well, I think Zillow would be getting a very good deal for $1 million for a better home valuation, since the company's worth $6 billion on publicly traded markets.
We'll come back to that in a second. We're coming to a commercial break. Don't go away, because you want to hear the answer to this story.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Brian Copley of City Builder. We're talking about, or I started talking about, I raised the question of what Zillow is doing with this prize to entice a number of groups to come up with a better algorithm for estimating the price of homes. Now we'll come to a question about why they would need to do that in a second. But I thought I would give some background to this whole concept of giving a prize, a significant prize. We had the same thing happen for cleaning up the oil spill around the British Petroleum oil spill in the Gulf. They opened a prize of, $5 or $10 million to groups, and they got tons of groups coming up and thinking outside the box of ways to do it. And in fact, most did not work, but there were 2 or 3 that came up with ways to do it more efficiently, more effectively, and more quickly than traditional methods. This is something that is going on. It's something that's been used a number of years, but we're suddenly seeing a revival of this whole idea of awarding a big prize, putting a big prize out there, and enticing groups to come in and try to get an algorithm to better the pricing. So the question then becomes, why do they need to do that? So I'll turn that question over to you, Brian.
Well, I'll give you an anecdote for why Zillow might choose to improve its algorithm. The company drives consumer eyeballs to their website by saying, we're pretty good at valuing properties. But last year, their CEO sold his home for 40% off the Zestimate. And if that's the case, then they've got to improve that estimate.
40% above or 40% below?
40% below.
So what is there's a number of homes that are sold different, or Zillow is valuing different from the real value of the home.
You know, I'm not going to give Zillow's numbers. What I'm going to give are numbers that no one's ever heard before, which is that 1 out of 4 Seattle property owners has a property worth quite a bit more than they believe. And that's because of this city builder value, which is what your property is worth to a builder or to a developer as a site to build something else. If you look around the city skyscape, you'll find dozens and dozens of cranes. In fact, Seattle has more cranes than any other city in the United States. And that's because of this trend of urbanization. We have baby boomers and we have millennials moving back to the urban core. In fact, McKinsey recently released a study and said that 60% of the U.S. population will live in a dense urban environment by 2030. That's in 13 years. And so you have all these people moving back from the suburbs, ditching the car for Uber or for a walkable lifestyle, or taking the bike to work, especially when you've got global warming and the sun's coming out in Seattle like today. And so you have all of this space or capacity that's required to satisfy that demand, and builders and developers are struggling to find the lots to supply that. And so if you have a home, you owe it to yourself to find out what it's worth, not only as a home, but also as a site for future development. And you can do that at City Builder, and I'm going to spell it because we're a tech company, and tech companies misspell their names often because they can't find the .com. And it's CITYBUILDER. BLDR.
City Builder. So you have a website and you have a valuation of homes, both as a real estate, both as a residence, for example, and what a builder would pay for the home.
That's correct. And there's actually a third value that we're starting to discover that's even more exciting than the second. And that is that your house is worth one amount as a house. You might look to a real estate agent to figure that out, or Redfin, Zillow, one of those other valuation tools. The city builder value, which is what your property alone is worth to a builder or developer, but then there's a very interesting third value. And that value is what your property is worth when it's sold with an adjacent or contiguous property. I'm going to give you an example of some homeowners that learned something very interesting. 5 homeowners met together. We'd had a listing with one of the homes. We're a real estate brokerage. That's our business model. We help sellers get the most for their properties. And the one homeowner who was listed with us invited his neighbors. And we told them, your properties are worth 70% more if you sell them all together. Because individually, they're great sites to build a townhome, but collectively, you can build 150 apartment homes here. And a builder can pay more for that site. We went ahead and got an exclusive license or listing agreement with the 5 property owners, and we got that property under contract for 90% over the market value. We got 2 offers on it at 90% over what Zillow and Redfin and a traditional real estate agent might say that property is worth. So there's this very interesting new phenomenon of property owners banding together to see what the premium would be if they sold their homes together to create more dense housing.
And I think we're going to see more of that when you look at what's happening. As you mentioned, people are moving back into the city, the baby boomers are moving out of the suburbs into the city. The millennials are moving into the city. And if you look at how the city's responding to that with bus lanes, with bike lanes, they're responding to that as well. We're seeing a significant change in city living, both in demand for housing, transportation, and all the essentials that go into downtown living.
Well, I don't know about you, Mike, but I hate traffic. It is my least favorite thing in the world. I can be in a skippy mood and then get on I-5 or 405, God forbid, and you hit that first, bunker of cars, and you're not going anywhere for 30, 45 minutes. And thank God for radio. We've got someone like you to entertain us while we're sitting there. But, I don't care if you're 16 and just got your license. I don't care if you're a baby boomer or, if you're still driving at 100. Nobody likes to sit in traffic. And there's more and more people moving to these cities and commuting in every single day. And what used to be probably when you would come to Seattle, 30, 40 years ago, a 20-minute commute is now an hour. And that's just going to continue to go up. So I think this trend will continue of people moving downtown and housing becoming more and more dense.
And yet the studies show in 2004, when the big push went on for public transportation, 73% of the cars on the road were driven by single occupant vehicles. In 2015 or 2016, it has to be 2015, that had increased. The number of cars had increased and the percentage had increased to 76%. I think that's why we see Seattle as the 4th worst traffic congestion in the country. But that has to figure into this urbanization as well. People getting tired, as you say, of sitting in traffic, and the ability of being right there, close to theater, being close to restaurants, being close to shopping. All that's a positive about downtown living.
Well, Seattle deserves some credit for taking a stand recently with the passage of Sound Transit 3, this $50 billion hotly debated transportation bill that was passed that will essentially connect all the way down from Tacoma up to Everett at some point. So the entire Puget Sound region on the east side of the sound there. And that's not an easy bill to pass. There are still questions about whether or not it will be adopted the way that it has been through University District and Capitol Hill, which has been great. They've had twice the ridership they thought they were going to have. But I think that's got to be the future, just because you can't add any more cars and have people's lifestyle improve. And that's what people are after. People do want to help the environment. They want to do things that are good for their city. But really, people make decisions based on a lifestyle that they want to have. And traffic's not part of anyone's choice of a lifestyle. I can guarantee you that.
That's true. So anyway, we've drifted off the subject of City Builder. Come back to City Builder. Tell us more about the website and what you do. And so if someone had an interest in selling their home or getting together with their neighbors to put together a plan for their neighborhood, how would they do that?
Well, we've tried to make that process as easy as possible. So you go to citybuilder.com, you type in your address, you claim your property, and we show you those two values. So we show you what the fair market value for your home as a home is today, or your property. It doesn't have to necessarily be a home, but most are. And then we also show you what a builder or a developer would pay for that property. And once you've engaged us as a brokerage, we give you a lot of additional information on what your property would be worth selling with your neighbors. And a lot of people are choosing to do that. We have a group of 7 property owners just north of Seattle that have properties worth fair market value roughly $2.5 to $3 million. We're listing those this week at $6.5 million. So those people will be selling for twice what they believe their properties to be worth. And that's a huge economic gain. You talk about beating the market, that's doing pretty well. And so we think that people deserve to know that information. If they're one of the property owners that don't have a site that's optimal for development, we've partnered with some of the best brokerages in the country to help those people get a good deal on selling their home.
So again, give us the website.
It's CityBuilder, CityBLDR.com.
Say it again.
CityBLDR.com.
Hopefully you got that. We will tweet that out as well. We will put it on our website about money. So there's a number of ways you can find it. You can find it on our website, adamsfinancialconcepts.com. So do check that out. Find out what your home is worth. If you ever think about moving or think about upgrading, now is the time. I mean, look around and look at what's happening to Seattle. Now is the time. After the commercial break, I'm going to come back, talk about the announcement today, and talk about something else that's going on. So don't go away. We've got a lot to cover in a very short time. We'll be back in a minute.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and probably, most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019 or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
.org to learn more.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So there's 2 things I want to get to today and try to get through very quickly as we end up. The first thing was the big announcement from the White House today that we're withdrawing from the Paris Accord, the climate change, the thing that was signed by 200 nations. I have some concerns right now about what's going on with the White House. You know, there was a recent trip to the G7 nations, and the president said that Germany was bad, the trade deficit, we needed to do something about the trade deficit with Germany. Angela Merkel's reaction after the meetings was that they can no longer depend upon America as a partner. I think that's tragic. That's one of our closest partners. And guess who shows up 2 days later in Germany? The president of China. We withdraw earlier this year from the Trans-Pacific Partnership, the TPP. And who shows up the day after we withdraw in Peru and begins rounds of talking to South American countries, Latin American countries, and Mexico? China. You know, today, for climate change, the idea is we're withdrawing and maybe we'll renegotiate. Well, that was signed by 200 nations. And the response from the other nations has been, no, we're not going to renegotiate. Who will take control? You can bet there's a good chance it'll be China. Very good chance that China is assuming the leadership that America's had in the world. And that causes me a lot of concern because for all of my lifetime, America has been the world leader. It seems that we're conceding that to China and to a lesser degree to Russia. You know, if you look at where we are in the world, we lead the world in business and entrepreneurship and technology. But 33% of the S&P 500 companies' revenues come from overseas. It's not a small amount. We're dependent upon that leadership. There's a reason to believe that so many companies were against withdrawal from the Paris Accord. Some companies will say it's a matter of 4 years and changes will happen in 4 years and there may be a change in Washington, D.C. But in any regards, it concerns me a great deal. I think it's going to have an impact. I think it's going to cause not positive cause for jobs. It's going to be a loss of jobs. It's going to be a loss in renewables, which already employ 3 times as many workers as do coal mines. But anyway, I'm going to talk more about it as I look at the impact of it over the long term. I think it was a big issue. Yesterday at Rotary, the presentation was by Andrew Russell, who happened to mention Andrew Russell is the artistic director of Intiman, the Intiman Theater, and he was talking about theater as a reflection of life. But he mentioned that one of the things they were doing is working with Ric Edelman. And that brought to mind, Ric Edelman is the background. He is the 3rd best known financial person in the world. Susie Orman is 2nd to Jim Cramer. Jim Cramer is better known than anyone else. Not that he gives great returns, not that Susie gives great returns, but they're recognized in the financial world. Ric Edelman is in single digits, Susie Orman at 50%, 30%, Jim Cramer, it's higher than that. 18 months ago, I was invited to a private conference with a limited number of us where Ric Edelman was to be one of the keynote speakers, and I went specifically to hear what he had to say. Flew to Florida for the conference. It was a couple days of conference, but 5 days before the conference, they said that Rick was not going to be able to appear in person. He was going to appear on video. I could have my money back. I could cancel my trip, but I decided to go anyway because I was so interested in what he had to say. The background is Ric Edelman's generating 25,000 leads per year. He has a radio show with a lot higher listenership than I do. It broadcasts nationally. He has a TV show. He does 800 seminars per year. He does media cultivation. He writes a book every year. And I was curious about how you do 800 seminars, but having gone to this thing, I now know how he does seminars because it was a video presentation. He opens the presentation live, you get a video, and then he takes questions. If you didn't know it was a video, during the entire presentation, he asked for no questions during the time of the presentation. You could believe that he was speaking live on video. I believe that it's a canned video. But 75% of the clients of the Edelman Group say it's the best company they've ever worked with among all the companies, not just brokerage, better than Nordstrom, better than Starbucks. That was Edelman. That's what I wanted to see. He has 113 advisors, multiple offices, And his approach is to put together a very cookie cutter approach. He said during his presentation that even if the financial advisor meeting with clients is not there, another advisor can step in and the same plan will be presented as if it was the original advisor. There's no concern at all with superior performance. There's no concern about deviation or molding things to the client. It's a cookie cutter approach. Everybody falls into exactly the same approach. So I talk about 5 different qualities of a company where service is superb at Edelman. Access is high. The product is average. The price is average. The quality is average. Actually, the price has been dropping, actually. But the idea is that they present a complete picture, including right down to the office. They set up the office. There has to be a window view, and the advisor, his desk sits in front of the window, and he has a couch and a table. And when clients meet, they come in, they sit on the couch. The advisor swivels his chair around 180 degrees to face the couch across the coffee table. And the coffee table, he doesn't want anything but Rick Edelman materials. No Wall Street Journal, no financial advisor magazines, no financial magazines, because one of those might say something negative, and he doesn't want anything negative. And now he's working with Intiman Theater to develop the storylines. So he's going to come up with a whole list of stories that each one of these advisors can tell. And they'll be the same. So that you can walk into one of the Edelman offices in Seattle. You'll hear exactly the same story as walking into Orlando. When you think about it, think about McDonald's. You know, every McDonald's hamburger has 2 pickles. It has mustard on one side. It has mayonnaise on the other side. It has 2 pieces of lettuce and a tomato. Everything is exactly right. I once had an interview with a person who had gone through McDonald's University. He said he could take apart and put together, blindfolded, the milkshake machine. Everything had to be exactly perfect, exactly the same. And that's what Edelman is. If you want real, it's not at all about client needs. It's not about the client and superior performance. It's all about uniformity and being exactly the same. Tremendous success story. But I don't think it's in the client's best interest. It's in Edelman's best interest. Anyway, that wraps up this week. Soon I'll be back, and I want to talk more about climate change because I do think it's going to have an impact on what's going on. So join me again next week, and we will be talking about money. And until then, have a great weekend, and I will be back next week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.